What if the silver you think you can buy tomorrow simply isn't there when you need it? What happens when the world's largest bank quietly accumulates more physical silver than entire nations hold in their reserves, while ordinary buyers face empty shelves and premiums that double overnight? Right now, as silver trades around $67 per ounce, hitting all-time highs day after day throughout December 2025, something unprecedented is unfolding in the physical metals market. The gap between paper promises and actual metal has never been wider. And at the center of it all sits JPMorgan, holding what many believe to be the largest private stockpile of physical silver in modern history. The numbers are staggering. Reports suggest JPMorgan controls approximately 750 million ounces of physical silver. To put that in perspective, that's nearly the entire annual global mine production. It's more silver than the Hunt brothers ever dreamed of accumulating when they tried to corner the market back in 1980. But unlike the Hunt brothers, who bet everything on paper futures contracts and lost it all on Silver Thursday when prices crashed from $50 to $10 in a single day, JPMorgan has been quietly stacking physical metal for over a decade. Here's what makes this situation different and why retail buyers should pay attention. Between June and October 2025, JPMorgan reportedly sold off its entire 200 million-ounce short position in paper silver contracts. For years, the bank had been accused of suppressing silver prices through aggressive short selling on COMEX. Now, those shorts are gone. Zero. For the first time in history, JPMorgan is long on both physical and paper silver. Think about what that means. The institution that many believe kept silver prices artificially low for years has completely flipped its position. And the timing couldn't be more interesting. Silver began its explosive rally in late November 2024, surging from the low 30s to break through $50 by early October 2025. On October 9th, silver finally shattered its previous all-time high from 1980, hitting over $54. By November 28th, after a 10-hour trading halt on COMEX that sparked wild speculation, silver spiked to over $56. Then came December. On December 9th, silver crossed $60 for the first time ever. By December 11th, after the Federal Reserve announced another rate cut, silver reached $64.65 per ounce, setting a new historic peak. And as of mid-December, it's still trading in the mid-60s, up more than 120% year-to-date. That makes silver the best-performing major asset of 2025, even outpacing gold's impressive 32% gains. But here's where the story gets really interesting for anyone trying to actually buy physical silver. While prices soar on paper, the physical metal is becoming increasingly difficult to obtain. Coin dealers across multiple countries report situations that haven't been seen since the pandemic panic of 2020 or the global financial crisis of 2008. In Vietnam, dealers say they can't even get raw materials to mint new coins. In Canada, the Royal Canadian Mint has faced significant problems sourcing silver blanks for the popular silver maple leaf coins. Major wholesalers that used to stock millions of ounces now have inventories measured in thousands or even hundreds. One dealer reported calling a major wholesaler for mercury dimes, those pre-1965 U.S. coins that contain 90% silver and are highly sought after by stackers. The wholesaler's response? They had 8 dimes. Not 8 bags, not 8 rolls, 8 individual dimes. That's 80 cents face value of coins from a supplier that normally moves silver by the ton. The premiums tell the real story. In normal markets, you might pay $3 to $5 over spot price for a generic silver round or bar. By mid-2025, premiums on popular coins like American Silver Eagles had widened to $9 to $12 per ounce above spot in the UK market, up from just $3 to $4 earlier in the year. Some buyers in Asia are offering premiums above exchange prices just to secure metal, yet shelves remain empty. When people are willing to pay significantly more than the spot price and still can't get metal, that's not speculation. That's genuine scarcity. Compare this to what happened in February 2021 during the Reddit-driven silver squeeze. Back then, retail demand overwhelmed the system so completely that major dealers like SD Bullion, APMEX, and JM Bullion had to limit orders or shut down entirely. JM Bullion's website crashed. Australia's Perth Mint, which had operated continuously through world wars and financial crises for over a century, suspended orders for silver cast bars for the first time ever. The U.S. Mint was forced to ration silver eagles, implementing emergency allocation measures that, by the way, never really ended. Those rationing policies became the new normal. But the 2021 squeeze was driven by a wave of retail enthusiasm that eventually cooled. What's happening now, in late 2025, feels structurally different. This isn't just Reddit traders piling in. Industrial demand is setting records. The solar industry alone is projected to consume massive quantities of silver, with total industrial usage expected to hit 1.2 billion ounces in 2025. That's billion with a B. Electric vehicles, data centers, electronics, all of them need silver. And unlike investors who might sell when prices get high enough, industrial users have no choice. They need the metal to function. The supply side makes the situation even more precarious. According to the World Silver Survey from the Silver Institute, the global silver market has been in deficit for 5 consecutive years. That means demand has exceeded supply every single year since 2021. The projected deficit for 2025 alone is approximately 117 million ounces, one of the largest shortfalls in recent history. Mine production has essentially flatlined at around 813 million ounces per year. And here's the kicker. About 70% of global silver output comes as a byproduct of mining other metals like copper, zinc, and lead. That means silver supply doesn't respond quickly to price increases. Even with silver above $60, miners can't just decide to produce more silver. They'd have to expand their base metal projects first, which takes years and hundreds of millions in capital investment. Meanwhile, exchange inventories have been draining. COMEX and LBMA warehouse reports show total silver holdings dropped from 290 million ounces at the start of 2024 to below 210 million ounces by October 2025. That's nearly a 30% decline. London, one of the world's key silver trading hubs, has seen total holdings fall almost 40% since 2021, marking one of the steepest declines on record. Now layer in what's happening with the futures market. Silver futures have repeatedly flipped into backwardation in 2025. That's when spot prices trade higher than futures prices, the opposite of normal market structure. Backwardation signals that traders value immediate delivery more than future promises. It's a classic sign of tight physical markets. Some short sellers are scrambling to buy back contracts to limit losses. Borrowing fees for short positions in silver ETFs like SLV have exploded to nearly 10%, with shares to short completely unavailable. This brings us back to JPMorgan's positioning. The bank has been accumulating physical silver since at least 2011, when silver hit its previous high of $49.95. Between May 2011 and December 2013, analyst Theodore Butler calculated that JPMorgan accumulated between 100 and 200 million ounces of physical silver. By 2017, their COMEX warehouse held over 107 million ounces, representing over 50% of all deliverable silver on COMEX. Some estimates now put their total holdings at over 750 million ounces, when you include physical silver purchased on the open market, silver in their COMEX warehouse, and their role as custodian of the SLV ETF. In just 6 weeks during late 2025, JPMorgan reportedly added another 21 million ounces to their stockpile. Where did they find 21 million ounces in 6 weeks when coin dealers can't get 8 mercury dimes? That's the scale difference between institutional and retail markets. Banks operate in a different world than the guy trying to buy a roll of silver eagles at his local coin shop. So what does all this mean for retail buyers? The uncomfortable reality is that when physical supply gets tight, retail is the first to feel the squeeze. Refineries are overwhelmed with backlog. Many are paying only half of spot value for scrap or junk silver because they simply can't process it fast enough. This echoes what happened during the big melt of 1980, when refinery backlogs stretched for months and physical premiums exploded while the paper price was actually falling. Some refiners have stopped buying certain products altogether. Others have limited the amount of 1-ounce bars, 5-ounce bars, 10-ounce bars, and 90% silver coins they'll accept per week from dealers. These constraints create bizarre market dynamics, where a coin shop might tell a customer they're not buying today, not because they don't want the silver, but because they literally can't move it to wholesalers fast enough. The entire supply chain is clogged. Meanwhile, premiums on collectible silver have collapsed in a different way. Coins that used to carry significant numismatic value above their silver content are now trading at spot or even below melt value. America the Beautiful coins, which carried premiums when silver was $20, are selling at spot now that silver is $65. Pre-1933 U.S. gold coins that once commanded strong numismatic premiums have seen those premiums all but disappear. Even graded Morgan dollars and peace dollars, typically $15 to $30 over melt for average circulated specimens, are trading for just $5 to $10 over melt in many cases. What's happening is that the sheer value of the metal content has surpassed the collectible premium. When a common date St. Gaudens $20 gold piece contains over $2,000 worth of gold at current prices, who cares about a $50 numismatic premium? The metal is the value. This creates opportunity for smart buyers who understand the difference between generic bullion and semi-numismatic pieces that are temporarily priced like bulk metal. But here's the critical question. If JPMorgan and other institutions have positioned themselves long on physical silver, what happens when prices really take off? Some analysts are projecting silver could hit $100 per ounce in the first quarter of 2026. Bank of America raised its 12-month silver target to $65, though that target was already exceeded by mid-December. Adjusted for inflation, using 1980 methodology, the old high of $50 would be equivalent to over $600 today. Even using more conservative inflation adjustments, silver's inflation-adjusted peak would be around $145. If silver approaches or exceeds $100, expect premiums to go absolutely bonkers. During the 2020 pandemic, premiums on silver eagles hit 50% or more over spot at some dealers. Small shops were completely sold out for weeks. The U.S. Mint couldn't keep up. That was with silver in the 20s and 30s. Imagine the frenzy at $100 per ounce. Here's what retail buyers need to understand. When you buy from a coin shop or online dealer, you're at the end of a long supply chain. Silver gets mined, refined, fabricated into products, distributed to wholesalers, and then allocated to retailers. At each step, institutions with deep pockets can step in and absorb supply. JPMorgan can call up a refiner and buy 1 million ounces. You're calling to buy 10 1-ounce rounds. Who do you think gets priority when metal is scarce? This isn't necessarily nefarious, it's just how markets work. Big money moves first, retail comes last. The 2021 silver squeeze proved that even a modest surge in retail demand can overwhelm the system. Now imagine sustained institutional buying combined with relentless industrial demand and a structural supply deficit. The math doesn't add up to plenty of silver available at reasonable premiums for retail buyers. Some worry about rationing, allocation, or even retail being effectively priced out or banned from certain products. It's not that a law would be passed saying you can't buy silver. It's that when premiums hit 30 or 40% over spot and delivery times stretch to months, you're functionally banned by price and availability. You might have the money, but there's no metal to buy at any price you're willing to pay. Compare JPMorgan's current strategy to what the Hunt brothers attempted 45 years ago. The Hunts accumulated around 200 million ounces between physical holdings and futures contracts by early 1980, representing roughly 1/3 of the world's supply at the time. They used massive leverage and borrowed heavily to finance their purchases. When regulators changed the rules on margin requirements through COMEX Silver Rule 7 and the Federal Reserve cut off their credit, the brothers couldn't meet margin calls. They lost over $1.7 billion and were eventually bankrupted, convicted of conspiracy to corner the market, and banned from commodities trading. The key difference? The Hunt brothers bet on paper contracts. JPMorgan is holding physical metal. If you own the physical silver outright with no leverage, nobody can margin call you. Nobody can change the rules and force you to sell. You just sit on your metal and wait. The Hunts' leverage made them fragile. Physical ownership makes you anti-fragile. Another key difference? The Hunt brothers were flamboyant Texas oil men buying silver as a hedge against inflation. JPMorgan is a too-big-to-fail bank that holds the physical metal, manages the largest silver ETF as custodian, operates major COMEX warehouses, and participates in the derivatives market. They're embedded in the system itself. When the Hunt brothers threatened to break COMEX through deliveries, regulators changed the rules and crushed them. If JPMorgan's accumulation creates stress in the physical market, who's going to step in and force the world's largest bank to sell? For everyday buyers, the lesson from all this isn't to panic, but to understand the landscape. If you're thinking about adding physical silver to your holdings, realize that the window of easy availability at reasonable premiums may be closing. Not tomorrow, maybe not next month, but the trajectory is clear. Every deficit year makes the hole deeper. Every million ounces that goes into industrial use or long-term institutional holdings is metal that's not available to the retail market. So what should buyers be looking for right now? First, understand the premium structure. Generic 1-ounce rounds and bars are typically the cheapest option. 90% U.S. silver coins, often called junk silver or constitutional silver, historically trade close to melt value and are instantly recognizable. Right now, those premiums are relatively low by historical standards, hovering around 3 to 5% over melt for bulk purchases in many cases. That's attractive compared to what happens when retail demand spikes and premiums hit double digits. American Silver Eagles carry the highest premiums of any bullion product, typically $4 to $8 over spot in normal times, but they're also the most liquid and widely recognized. If you're paying $8 over spot for an Eagle today, that might seem like a lot, but if premiums go to $20 over spot during a supply crunch, that $8 premium suddenly looks like a bargain. Watch for low-premium semi-numismatic pieces. Those America the Beautiful 5-ounce coins at spot? That's unusual. Morgan and Peace dollars at $5 to $10 over melt for common dates? Historically cheap. These kinds of opportunities appear when the metal value overwhelms collector premiums, but they won't last if silver consolidates at these levels or pushes higher. The flip side is to be extremely careful about counterfeits. High prices create high incentives for fraud. When silver rounds are selling for $67 each, the profit from selling fake rounds at even a discount to real ones becomes very attractive to criminals. Dealers are reporting more fakes coming through their doors. Test everything. Buy from reputable dealers who stand behind their products. If you buy from a shop with a strong reputation and a fake slips through, they'll make it right. Buy from some random guy on Craigslist and you're on your own. For those watching the market but not yet buying, the key indicators to monitor are premiums, backwardation in futures, and exchange inventories. If premiums continue widening, that signals physical tightness. If backwardation becomes persistent rather than occasional, that's a red flag that the futures market is under stress. If COMEX and LBMA inventories keep draining, especially registered silver available for delivery, that shows the physical supply buffer is shrinking. The other factor to watch is industrial demand. As long as solar installations, EV production, and data center construction keep expanding, industrial consumption will remain strong. Unlike investment demand, which can vanish overnight if sentiment shifts, industrial demand is steady and non-discretionary. Companies need silver to build products. They'll pay whatever they have to pay. One last piece of the puzzle: the Federal Reserve's policies. The December 2025 rate cut that sparked silver's latest surge to all-time highs was accompanied by announcements that the Fed would start buying short-term treasuries. That's essentially quantitative easing by another name. It expands the Fed's balance sheet and injects liquidity into the system. Historically, precious metals perform well when monetary policy is loose. If the Fed continues cutting rates and expanding its balance sheet through 2026, that's bullish for silver. But here's the thing nobody can predict: black swan events. The silver market is small enough that a single unexpected event can cause massive price swings. A major mine collapse, a geopolitical crisis that spikes safe haven demand, a derivatives blow-up at a major bank. Any of these could send silver to $100 seemingly overnight. And when that happens, physical availability will matter more than paper prices. What if silver hits $150, approaching its inflation-adjusted high, and you can't actually buy any because refineries are backordered for 6 months and dealers have none in stock? That's the scenario that keeps long-term silver buyers stacking metal now, rather than waiting to see if prices dip. Once genuine shortages hit, price becomes irrelevant because there's nothing to buy. JPMorgan's 750 million-ounce stockpile represents about 90% of annual mine production, or roughly 15% of total above-ground investment silver. That's an enormous concentration of supply in the hands of one entity. Combined with industrial users hoarding inventory, ETFs accumulating metal, and retail buyers stacking what they can, the available pool of silver willing to be sold at current prices shrinks every day. The question for retail buyers isn't whether silver will go higher, though many believe it will. The question is whether physical metal will be available when you want it. Because if JPMorgan and other institutional players have truly flipped long on physical silver and are holding for much higher prices, and if industrial demand keeps eating up supply, and if mine production stays flat while deficits continue year after year, then at some point, the physical market breaks away from the paper market completely. We saw glimpses of this in 2021, when local coin shops were selling silver 20 to 30% above COMEX spot, and customers paid it willingly. We're seeing it again now, with premiums widening and inventories thinning. The next phase could be even more extreme. The silver market might reach what some call the unobtainium stage, where metal isn't just expensive, it's unavailable at any reasonable price. For anyone considering physical silver as part of their holdings, the time to act is when metal is available, not when it's scarce. Prices matter, of course, but availability matters more. You can always sell silver for whatever the market price is, but you can't buy what doesn't exist. Right now, in December 2025, you can still call most dealers and get silver in a reasonable time frame at premiums that, while elevated, aren't completely insane. Will that still be true in March 2026? June 2026? That's the bet you're making if you wait. The setup is unprecedented. The largest bank in America, previously the biggest short seller of silver, is now sitting on more physical metal than most countries hold in their reserves. The market has been in deficit for 5 straight years. Industrial demand keeps growing. Exchange inventories keep shrinking. Futures markets show persistent signs of stress. Retail premiums keep widening. And the price, adjusted for inflation, is still far below its historic peak. Whether silver goes to $100, $150, or stays around $65 doesn't change the fundamental dynamic. When institutional money controls the supply and has no reason to sell, retail buyers face an increasingly difficult path to acquiring physical metal. That's not speculation. That's simple supply and demand in a market where supply is finite and demand shows no signs of slowing. So here's the bottom line. If you've been thinking about adding physical silver to your holdings, understand that the landscape has changed dramatically. The era of easily available silver at small premiums may be behind us. What comes next could be a market where physical commands massive premiums over paper, where delivery times stretch to months, where smaller buyers simply get priced out or find shelves empty when they finally decide to buy. JPMorgan's 750 million ounce position didn't happen by accident. The timing of their short exit didn't happen by accident. The collapse of numismatic premiums and the surge in physical tightness aren't coincidences. Something big is brewing in the silver market, and retail buyers who wait for perfect clarity might find they've waited too long. The silver you think you can buy tomorrow might not be there. That's not fear-mongering, that's math. And in a market this tight, with this much institutional accumulation, math matters more than hope. If you found this analysis valuable, make sure to subscribe to stay updated on silver market developments. Drop a comment below sharing your thoughts on JPMorgan's positioning and what you're seeing at your local coin shops. Are premiums widening in your area? Is inventory thinning? Let's hear your boots-on-the-ground perspective. Hit that subscribe button and join the conversation in the comments.